It's great to be here with all of you. Also, I'm going to kick it over to Liz Cahill, who's our Senior Associate of Market Insights. She's going to be sharing with us a lot of great macro data trends.
Thanks, Bo. Hello, everyone. I'm beaming in from San Francisco. It's great to be here. It's good to see a lot of folks gathered in New York.
Awesome. Well, thanks for joining us virtually. And then let's introduce our October fundraising guest. So this is Jason. He's here with us. Jason's got a really eclectic background. He is the managing partner at Left Lane Capital, also a graduate of University of Pennsylvania in a BS in Econ and minor in Spanish. Jason started his career in Insight Ventures, 2012, investing in companies like Smartsheet, Anagua, Brand, and Pearlsite. He's also an early employee at Uber in 2013 as operations manager, helping launch 3 out of the first 100 new markets for Uber to enter in internationally. He also joined Red Sea Ventures in 2015 as principal, working on early stage companies, great brands we know like Allbirds, Sweet Green, Pros, My Village. Jason's also a prolific angel in the New York ecosystem, and at Left Lane, he focuses on D2C e-commerce, supply chain marketplaces, food tech, and the pet business. So welcome. We're super excited to have you.
Happy to be here and try to be helpful to you all. It's good to meet you.
I think you wore the same jacket from the picture.
Yeah, you really.
I respect that it is the same brand, but this is a navy that is black.
Jason's got a uniform.
But good call.
Yeah.
Observant crowd.
It's not a Patagonia.
All right, let's get started. Next slide. So this fundraising workshop is really a place for you guys to kind of think about the 3 whys before you embark on this journey, whether you've already raised money or thinking about entering a raise. Definitely, this is a very introspective process. So thinking about why you, why now, why the problem. A lot of what we're going to be covering is, advice, but it's not a one-size-fits-all advice. Next slide. All right, we've already given you the caveat. So a lot of the data we're presenting here is going to be New York specific, as well as macro data that we have from our own proprietary data sets through company spending, venture valuations. All right, Liz, let's get started.
Thanks, Bo. So hello, everyone in New York. Everyone here, I assume, is looking to fundraise, and I wanted to bring some context to the current macroeconomic environment and how that applies to you as an early stage founder looking to raise money. The 3 graphs on the top, I think, give us a sense of context of where we're at in the broader economy. What's going on right now? You've heard the headlines. We're in a time period of record inflation. This is due to a number of factors. One of those factors being ongoing issues with our supply chain. First, it was COVID-19 disruptions, and some of those still do persist. China's zero COVID policy has continued to cause ports and factories to shut down. There's also been recent flooding and droughts and other climate disasters impacting factories in China. This is some very real consequences, of climate-related issues starting to appear. They're affecting our supply chain. Also there's been the ongoing war in Ukraine that's disrupted not only food, but also oil markets with Russia being sanctioned. It's sort of reshuffling our oil supply chain. They're still selling their oil. That's a whole nother conversation, but it's just disrupting the supply chain. It's changing how Europe is purchasing their fuel. So this is just, creating this ongoing chain reaction throughout our supply chains. The Federal Reserve, they have 2 mandates, and that is to keep unemployment low and to keep inflation low. And right now, unemployment is still relatively low across the board. I know we're hearing rumblings of layoffs here and there, but broadly, unemployment's still low. So the Fed is going to raise interest rates and keep raising them. When interest rates go up, this startles equity markets. Money becomes more expensive, to put it simply. So companies are going to scale back on borrowing money for big capital expenditures. Large projects slow down. It's more expensive to borrow money to buy a home. And that's what drives a lot of consumer spending. So this is going to send public markets down. It's not only interest rates, but also some of the supply chain issues that still persist are really, eating into companies' bottom lines. And there's some other fundamental forces at work here. So that's why you see, as in tandem, our public markets are falling. So this has also closed the IPO window. Last year, we had 70 VC-backed companies IPO. This year, we have only had 3. That's right. So very dramatic fall in the IPO window. There's less exits out there. VCs are getting a lot more spooked. You're seeing now, after the great financial crisis, venture has become increasingly correlated to the public markets. This is something that many people find surprising, but as the industry has matured and you have more finance people in VC, it's less of the tech guru who's investing money very long term. It's a lot more professional money managers. The public markets really track to private markets. There's a bit of a delay, and it's a bit more prominent at the late stage, but you do see VCs reacting to changes in the public market. I'm going to get into that a little bit later. But right now we're in a period of record dry powder. We've got $493 billion, ready to be deployed over the next few years, but you may have had a hard time fundraising. Deals are not happening. So at least not at the same rate as in 2021. So we'll dig into this a little bit more, but the dry powder is there, but it's not being deployed in the same way it has previously been deployed in years like 2021. So if we want to hop to the next slide, I did want to break out that dry powder really briefly and share a trend that I found to be interesting. Preqin is a data provider we use, and they track funds by stage at which they invest, usually funds. And when they announce a new fund, they're going to say, we have this earmarked for, general venture, all stages, or we have it earmarked for early stage. And there's been a big pop at the seed level. That's the purple line down at the bottom. And I thought this was really interesting. Bessemer has raised a historically large seed fund. It's $3.5 billion. It's the largest fund they have ever raised in their history, and it's the 9th largest fund ever, according to PitchBook. You've also seen Coatue, Tiger, other groups raise very large seed funds this year. And that's going with the trend of the super early stage companies are a lot more protected from the public markets. So VC firms are very interested in looking at the earlier stage companies because they have a longer time horizon for going public. So it's a bit of a safer bet right now. So that's great news for early stage founders. We're going to pop to the next slide. So looking at VC fundraising in 2022, we are not going to beat 2021. That was a record year. About $341 billion was deployed nationally into VC investment. This is across the US. This year, we're going to come in lower than that, but it's still going to be above all prior years. For one of our latest reports, our State of the Markets reports, we looked at 2 prior downturns. We looked at the dot-com bubble, and we looked at the Great Financial Crisis. And we plotted 2 scenarios for funding over the next 3 years based on both of those situations. I will caveat all of this with the fact that we are in neither of these scenarios right now. We are not in as severe of a, we're not calling what we're in now a recession yet. It's not been declared, and it may have already happened, but it's not the Great Financial Crisis. We're not seeing a meltdown of that scale, and it's not the dot-com era right now either. Tech is much more embedded into our economy, much more, established and diversified. So we're not in either of these scenarios, but we wanted to show 2 really tough economic scenarios and what fundraising would look like based on those 2 periods. What I will say is it doesn't go down to zero. We're still going to have fundraising activity happening over the next few years. and think about how severe the great financial crisis was, just, living through that. We still see in 3 years, if we had a great financial crisis happen, we would be back to being above 2021 in about 3 years. So I think it's nice to look at these two past periods of time and put them into perspective. I wanted to take a look at seed and Series A deals. So this year we've had less seed and Series A deals nationally, also in New York. And seed, though, is projected fundraising wise, though, to be a little bit above last year. And this is because we've had 12 $100 million plus series seed deals this year. The Bored Ape Yacht Club, you might have heard of them. They raised a seed deal that was $450 million. So in perspective, in 2021, we had 4 seed deals that were $100 million plus. And this is just how the deal is classified. So it's better to look at more the median seed deal size. We have one deal that was that big. So this is where it's important to look at both the total dollars invested, but also the number of deals. And Series A, we're seeing less than last year in terms of fundraising and also in terms of deal counts. I'm going to pop to the next slide. So I wanted to pull in some New York specific data. New York tends to follow the national trend. For seed, we're seeing more funding this year than last year. But again, that lower deal count. New York had 3 of those $100 million plus seed deals. Trust Machines was one of them. Power was one of them. There was a construction tech company in there. And then Series A, we are seeing a lot less, but I also would caveat this with not all Series A deals are being tagged as Series A. I think some of those larger seed deals, you would consider them a Series A. And New York tends to follow the national trend in terms of fundraising. So when I see New York Series A deals down dramatically, I actually think it's more likely to be slightly down as opposed to dramatically down, which we see in this graph, because New York tends to mirror the national trend. You want to pop to the next slide. So here we return, I'd say, to more, company level data, looking at, if you're raising a seed deal or you're raising a Series A, these are the ranges you can expect those deals and pre-money valuations to exist within. Looking at 2021 and 2022, we see the median seed deal going up in size. Same for Series A, same for pre-money valuations. Everything's gone up slightly. I will say a good chunk of these deals that are in this year's data set happened in Q1, which things were still tracking more closely to 2021's numbers. So we still had those eye-popping valuations. Investors were still really exuberant in the first quarter. It wasn't until we start to get into the second quarter that we see more headwinds appear. So I'll be really interested in, at the end of this quarter, to look back on the full year and see if we do see these deal sizes and valuations, keep up. And even into 2023, I think we're going to see potentially, especially some of those valuations, much more at the later stage, we'll potentially get a haircut. So if we want to pop to the next slide. Awesome. So this is our Series A deals. Again, similar trend to the seed. We're seeing, deal size and valuations go up generally. We see deal sizes kind of stay flat in New York for this year and last year, but the trend is always generally these deal sizes are going up year over year. We're seeing bigger deals across the board, which is great. That means companies don't have to go out and fundraise as often. That's been a trend for the past several years. So if we want to pop to the next slide. Excellent. So this is my second to last slide, so I hope I'm doing well on time. You hear a lot about, in a tough environment, like, our company's going to have down rounds, what's going to happen. All of the major venture firms right now are advising companies to conserve runway. That's the advice that Sequoia, Y Combinator, Redpoint, all of these prominent firms are giving to their portfolio companies. There are less deals happening. Investors are reticent to invest until they feel like, they can get a good deal. We're seeing deals that do happen on much more investor-friendly terms. The interesting thing is, if you look at the official data, we are not seeing an uptick in down rounds or flat rounds. But if we look at some of our proprietary data, where we look at mentions of down rounds and flat rounds in conversations, we can analyze some of our conversations, which is pretty cool. We see mentions of down and flat rounds are increasing. I will say official deal counts for down and flat rounds are usually a lagging indicator, because nobody's writing a press release and sending it to TechCrunch to say they raised a down round. It's generally really hard to find information on down rounds. This also applies to extensions. If you look at official data, extensions appear to be going down, but I also think this is a lagging indicator. Many people don't report extensions, so they don't get, if these deals don't get reported, they don't get picked up by any of the firms aggregating this data. Also, we've had this trend of deals being larger and larger, so companies have been raising more money. So in theory, they don't need to fundraise as often. So companies may still have some of that dry powder that they raised in 2021. We had a lot of companies raise more money in 2021 than they could possibly spend at the time. And many founders were just saving it, which is really responsible, because now we're in a tougher environment and runway really matters. So there are non-dilutive options to extending runway, and one of those is venture debt. We have seen an increase in venture debt on our platform at SVB. So we think a lot of founders are taking this option as a way to extend runway, but also not give up additional ownership. There's been a phenomena, it hasn't been widely reported on, but I saw a really great article on the information about this, that some founders are taking up rounds in name only. So they do get the higher valuation, but they're getting it on some pretty draconian terms. Investors might get 2 to 3 times liquidation preference above, other stakeholders in the company if the company were to go bankrupt. They're also taking warrants and ratchets. So if the valuation goes down, the number of warrants they have increases to make up the difference. So right now there's, you might see up rounds, but if you dig into the details, it's actually really tough terms for the founder, and investors are getting a lot more out of the deal than they previously would have. We're really seeing this sea change between investors doing whatever it takes to get a deal done to now it's investors are coming in with a lot stricter terms for these deals. So I wanted to also point to, we do have some advice on, how do you avoid down rounds? I will say, if a down round is your only option, and it's what you need to do to get your company to the next milestone, money is green. Do what you have to do to get your company to that next milestone. And if it's a down round, you got to do what you have to do. However, down rounds can be tough from an accounting standpoint. It basically can trigger, different clauses. If, investors have some anti-dilution clauses, they're going to get issued more shares of common stock. There's a great Cooley article that I can maybe circulate to this group afterwards, going into some of the technicalities. It's not just the reputation of like, oh, bummer, I took a down round, it looks kind of bad. There's actually more like technical complications that can occur. And investors don't like having to write down the value of their investments. So it's tough to explain to their LPs. So if you can avoid one, fantastic. So utilizing debt is one of the ways to do that. Raising extensions from existing investors, or working to get a private placement, which is basically just one investor comes in for a one-time transaction. And if you can, manage expenses thoughtfully, I'm working with some data right now on company transactions, and it really shows that companies are cutting spend. So I see that in the numbers, that is happening, which is great. And prioritizing unit economics over growth at all costs. I think the growth at all costs mindset is very much out of fashion. Investors do not want to hear that. So what the general consensus is, hey, what's the path to profitability? What's the next milestone? And just, ensure that, everyone at the company is sort of on board with that. So flip over to the next slide. So I'm going to end on a more optimistic note. We have, tech is a larger and larger part of our GDP. Looking back at the dot-com era and even the great financial crisis, tech continues to just become more and more of a part of our economy and our lives. So tech is not going anywhere. Even in some of, the depths of the great financial crisis, there were still deals getting done. Companies were still getting funded. I had a very seasoned banker tell me once, during the great financial crisis, there was a recession everywhere in the US except for the Bay Area. So I think tech is still, we're still very optimistic on tech, and that there's numbers to show why. And during some of the tougher economic times, that's when some of the best companies were founded. When people are putting their heads together and trying to problem solve, that's when you see the emergence of new business models. During the dot-com era, that gave rise to social media, and mobile came out of that era. And then with the great financial crisis, we saw the rise of the sharing economy. Really amazing, life-changing technologies that influence our day-to-day life, that came out of some of these periods of economic stress. And then with COVID-19, we also saw tech become more and more critical. We're all here on a Zoom call, and that's just become, how we work day to day with people all over the world. So I think it's really important to, think more broadly. I know the headlines are rough right now, but looking back over many periods of time, tech has steadily gone up and become more and more critical to our economy.
Thanks, Liz, for the great
problem. I expect some questions.
Some of your reactions to the macro trends, how you guys at Left are seeing valuations, thinking about pricing, what kinds of advice you're giving to the founders in your portfolio company.
Yeah, I think first of all, that was a great overview. I think we just had our annual investor meeting, and I wish we could have just plugged that segment in. We tried to do.
I'm happy to show up and do this anytime.
We tried to do our own version of it, but it was very similar, and I think a lot of folks are saying a lot of the same things. I mean, this is real. It's a real whiplash that occurred. Probably it was like one day. It just literally happened, and everything reset towards. And so valuations have. It's still in like free fall almost, honestly. Like a lot of the key top investors are deer in the headlights right now because a lot of the best companies don't, especially at the later stages. I would say seed and so we can. What's most relevant to you guys, I think, is actually the least affected because there's always new companies. As you said, this is the best time for a lot of companies. That's like a cliche at this point. So there will be more investment there. It's just at the later stages, there's no, people used to be looking backwards and saying, this could be this big of a company, so I can afford to pay this. And now people are saying, well, this is this big of a company and could become that big, so I can afford to pay this. It's just much more of a fundamentalist, multiples-based valuation framework. It's sobering and it's needed. I think it was kind of feeling like in our seat over the last 4 years, it felt like you had to pitch a perfect game in order to win the game, because of just where deals were getting priced to win. And it's not fun. Like when you find a company you really like, you just get outpriced. It's like going to a store and seeing the jacket you really like, and then you can't buy it, so you have to wear the same one every time. I think. I mean, the message for everyone right now is loud and clear. There is dry powder. People have money, but we're even, if not, the community is still overcorrecting for being cautious. We're gonna have to do deals, but there's a bit of, like you said, it's only been probably 4 or 5 months of this new normal max, and think about the amount of runway that companies had. 15, 20 months typically, because they were raising every kind of 6 months, the good ones. So the good companies can shoulder a downturn for a bit. So there's that bit of that adverse selection. I think that all of the dilution benchmarks have doubled. So if you're raising a Series A and you thought you were going to take 15 to 18% dilution, welcome to 30, 35% dilution. No joke. I mean, it's the leverage for the last 4 years is fully in the entrepreneur's hands, fully, and it's totally better. And whiplash is the best way to explain it because it happens in a day, and the founders are the last to realize it, but they are realizing it now. At first, it was our investors because it was hitting their public books, and then they were like, well, this is going to affect you guys, and then it was us. Now it's us sounding the alarms to these guys, but now, but yeah, it's very.
How are you guys thinking about dry powder for your fund? Like, is pacing and deployment period still the same? Are you guys thinking about slowing down and observing how the market's
slowing down? Because I think the amount of time it's going to take for these companies to grow to hit the returns that we've underwritten is going to be longer because they're not putting as much money into growth. So our hold periods are slightly longer, so our return periods are slightly longer. So what we need to show to our investors to go back out and get more money from them, it's going to take a little bit longer. We're talking probably a 30-month deployment versus a 40-month deployment, something like that, from a fun thinking standpoint. So it's not huge, but it factors in, and then also we're just trending earlier. I mean, we're doing enough. The air is unbreathable in the late 100 millions valuations right now. There were really four or five firms that were doing these billion-dollar private transactions that you'd read about in all of these kind of news articles. They ain't home right now. Like, you knock on the door, there's no one there. So you can't underwrite to that type of a round being done. And then you want to underwrite to a public company, better be a damn good, business. They can't just get a valuation at that price. You got to have the financials, you got to have the management team. It's back to building businesses again. So focusing on earlier stage deals also pushes out the deployment cadence.
Yeah,
So,
Marissa. I have a question.
compounding effects.
Hi, Marissa. Thanks for being here. I'm Stephanie. But question I have, and I'm asking a lot of investors right now, is are you looking to lead to take greater ownership, or are you looking to co-invest with other funds?
So I'm just gonna repeat the question for the Zoom attendees. Marissa's question is Jason looking to lead more rounds and increase ownership or to co-invest with other funds?
So this is a firm strategy question a bit. We only lead deals. Look for 15 to 25% ownership. It's just a strategy thing that we were kind of born with at Insight and that we've kept up. I've been in co-investing shoes before. What I can tell you is that when you're leading, you can form conviction and make a decision yourself. It's just in this business, it's so easy to say no to deals, and when you're just to be able to kind of just preempt to price to do that is to get a lot of your best deals done. It's harder when you're relying on an outside investor. The other thing is just ownership. If the way to return a lot of money without having to produce a ton of enterprise value is to own a lot of those businesses. The less you own, the more enterprise value you have to create in order to create that same outcome, right? So we, especially early on, really strive to own a bunch of these businesses so that we can, $1 billion exit can produce $300 million of gain or capital gains for us versus 10%. So also we're building a real firm. Like we've got 30 people now. We've got a value add team. So it's not like we need to farm out, co-invest to get value add. I think we are specialists in what we do, and it's less of the you know, well, this person can bring that and that person can bring, I think we bring a lot to the table for them to be able to get to the next round. And also we like to keep the ball control for that round after. Hopefully that answers that.
Thank you.
Yeah,
For, as you kind of go through this process, right, of being more difficult to put valuations on even in the early stages, are you guys seeing a shift in deal types, like where there's more people looking to do notes or things like that and can get through a period of time here where they can show trajectory on things?
deal structures.
Yeah.
Not really. There's definitely some notes, bridge notes. I think that as Liz said, venture debt's getting a lot more popular. We invest on clean terms and priced rounds, and that's just kind of always been the case and will always be the case. So like that's not necessarily changing. It's just the valuations attached to them. There's some terms. Like Liz was also saying, some people only value the sticker number, right? And there's a lot of different ways that you can economically compensate for a higher sticker number with liquidation preferences and some other things. Down rounds, as Liz also pointed out, are complicated. It can trigger a bunch of other things. Accounting can be a nightmare. But sometimes you have to do it, honestly, because it's the best thing for the employees to reflect their kind of entry price. But it's in terms of structures, it's been largely the same stuff. I will say one of the things that's interesting is a lot of the folks that did invest on notes that convert at a cap, which was pretty much usually an insane cap that they were coming in, almost sometimes uncapped, but or a 20% discount. A lot of those folks are getting pretty good deals right now because those companies are having to raise more money because they just raised the note instead of a full round. And they're getting in at 20% of a much more sober price. So that's an interesting kind of, it was more of a taboo type thing to do those types of deals, and those folks are actually benefiting a bit. But I wouldn't say any other types of deals are becoming hugely popular just because of the downturn.
Do you mind repeating a question for Zoom? We're having some audio issues.
Sure. I think I basically said, have you seen any different deal structures coming into play more as the evaluation process has gotten?
Got it. Cool. Awesome. Let's proceed. Next slide. So a lot of the questions to really start asking yourself before putting together a pitch deck are quite basic. One is like, what round are you raising, and having the introspection to understand how you're going to be deploying that capital you raise. Is the market timing right? How are you thinking about getting an intro to VC, prepping for first meeting, and we'll kind of dive more into the composition of the deck. Next slide. This is a slide that I really like to spend some time on because it kind of gives you an overarching framework of like what are the different life stages of pre-seed, seed, and Series A. Obviously, as Liz pointed out, during a very frothy market when there are huge $100 million seed rounds, like it does skew a lot of the data, but on a characteristic level, we like to kind of look at pre-seed as pre-product. It could be, a idea on a napkin sketch. It could be, a Figma, type of like mock. These are really rounds that are over-indexing on the team. So 90% of the team is really how the VC will evaluate the company. Are you the right team? Do you have the right background? Is this the right time, the right market for you to enter the space? The rounds are, going to be much smaller. So this could be friends and family round. This could be a traditional, lead investor. Usually it's more of a individual kind of cobbled together round on the cap table. Dilution is still going to be pretty small. So like less than 10% to 20%. You're going to see a lot of angels at the cap table at this stage, some accelerators. At the seed stage, this is where you start to think about the characteristic of, is the company starting to build traction? Are you able to launch a prototype? Do you have design partners, like is the business model more fully fleshed out? And at that stage, this could be a convertible note, safe note, or a price round. So typically at the seed, this is when founders start talking to lead investors, start thinking about institutional checks, and dilution does increase, up to even 25%. And the Series A is kind of what I call like the great adulting stage for companies. It's when, the product has some semblance of product market fit. You've reached, scale, traction. You show that there's, an ideal customer profile that you're targeting. This is when people start to give away board seats. So the lead investor coming at this Series A will usually want to sit on the board. It's going to be a price round, and dilution is going to, increase up to 20+%. So obviously these are more like characteristic features. There are going to be outliers in terms of how you think about the exact, round size as well as valuation. Kind of going back to Jason, like how are you guys thinking about in this market, like what the traditional like seed Series A looks like these days? Yeah.
It's like, it's so fun I started investing back at the seed stage in New York City in 2015. And it was like each one of those labels was moved one to the left. Like pre-seed was really like $1 million max. Seed was 2.5 to 1.5 to 2.5. A's were like 4 to 8 million. And then, your B's were the double digit rounds. Now you get huge, I forget the company was mentioned, but $400 million seed rounds, so there's a little bit of a nomenclature. We've done our 3 biggest rounds were all Series A's, and we've done tons of like Series D's and E's, and just so happens that a lot of bootstrap companies that get really big end up raising big Series A. But what I would say is prices are coming down for sure. I would say that the seed and the pre-seed and Series A less affected than later rounds for sure. Just because you still need to have the founder in mind a lot of times. Like there's a certain deal you always want a good deal as an investor, right? But you don't want the founder to take too much dilution where they're not fully incentivized to absolutely crush it, right? And so here, especially if you're dealing with some companies that are coming out of incubators, and then the founder now has this, you squash like a really prohibitive, $3 million seed round at a 9, at maybe like 5 post. That crushes their, 5 pre maybe. That still crushes their ownership. So I think people are still being mindful of the fact that you have to maintain a team that's really incentivized. Things aren't going incredibly down. Also, there is a lot of people still writing checks at the early stage. I think there's less of a deer in the headlights type of fear of just kind of catching a falling knife on valuation. Because from an absolute valuation standpoint, you're still in the ballpark of. But what I would say right now is like pre-seeds are in the high single digits valuation range. Typically, seeds are in the teens to mid-20s, and your A's are sub 50. Is kind of what I would be very general. Obviously, we did a $1.4 billion Series A last week.
Wow.
So the valuation, like again, there's a lot of difference to the nomenclature, but that's just a general framework.
Yeah.
That makes sense.
No, super helpful. Great, next slide. In terms of picking what the right time is to raise, we have changed the slide back to more of the traditional seasonality of fundraising, avoiding, the summer months when VCs are usually on vacation, as well as the holidays. Obviously, anecdotally, because the market is changing so much and correcting, a lot of founders are waiting till January to raise. But we do recommend starting to plant those seeds in terms of, talking to other founders who have raised from funds that you're interested in, having them start to think about, warm intros and as long as you're able to kind of cultivate those relationships early on before January, we advise kind of starting that process as early as possible. All right, next slide. In terms of qualifying investors, we think about the sales funnel for fundraising as almost like enterprise sales. Like you can start out with a spreadsheet of 30 to 100 qualified investors, but then in terms of thinking about the filtering process of what's the best way to get your first intros, refining your pitch, and then closing their lead, there's going to be a lot of cutoffs along the way. So definitely start out with as robust, large of a list as possible. Think about the ordering in which you're going to be pitching from, individual angels who may have less of a, rigorous process to working your way up to, the left legs, the sequoias, the Andreessens of the world. All right, next slide. And then in terms of thinking about your investors, there's a lot of variables here for you to consider. The stage of the fund, a lot of this is public data, the location, it doesn't make sense to be pitching to a growth stage investor if you're trying to close, your seed round. Doing a lot of due diligence around the size of the checks. It's okay to be asking if they're going to be leading around. The vintage of a fund is more nuanced variable because seeing how long that fund has been in the deployment period does help to kind of think about how active they are in terms of investing. And also watching out for the competitive landscape. Usually founders like to go to a VC because they've already invested in their space, but actually that is viewed as competition. So we highly recommend veering away from competitors, VCs who are already having competitors in their portfolio. Great, next. And this is kind of the culmination point for a lot of rounds, finding a lead investor like Jason. There's really kind of a transformational tipping point here. I always kind of allude to the Pareto rule of 80-20, 80% of the work of fundraising kind of, generates that 20% ROI here. Getting to a lead is really hard. So thinking about how to build up momentum in order for you to kind of create that fulcrum to get to Series A or getting a lead at the seed stage is very challenging. And I would characterize the lead as someone, who is taking a very sizable chunk of the round, usually a third or more. They may want board seats, and it's totally fine, from the very get-go if you're looking for a lead to ask, if that VC is a lead investor. I'm curious, Jason, when you guys think about leading rounds, what are the characteristics you're looking for to make that deal, a lead investment?
Just in general, what makes a good investment?
Yeah.
So I think there's a bunch of different ways that we get to a deal. A lot of times we can be thematically interested about the area that you're building something in. Other times it can just be someone in our network flagged it and you become really highly referenced. Other times we're just looking at data and your website traffic is going through the roof. There's some other signal. But typically what gets us excited is, at least for me, first and foremost, there's some usual authenticity to the founder and connection to what they're doing. Doesn't always have to be some super kind of life story, but there's some reason you want to build a single big business. Then I think I don't typically do a lot of investing in, say, crypto and a lot of these kind of newer markets. I do a lot of things if you think about my track record, it's things in dog food and medical scrubs and large existing categories of high repeat spend on the consumer side of the ballgame. That's kind of what we've specialized in. We're looking for big categories of spend, right? Generally, these are US markets of 5 billion plus, typically. When you get to defining a market is a whole exercise in and of itself. But I'm talking about the addressable market, not differentiate. If you're looking at healthy beverages, differentiating between this and applying maybe Suja versus Coca-Cola and sizing accordingly and whatnot. There's gotta be precedents for a big market, usually big players in the space. Usually you can point to an incumbent and say, you know, there's Red Bull at this size, or there's, you know, and looking for traction. You don't invest in napkin sketches or any sort of idea type of on the come stuff. Like, we can get excited about something that in Act 2 or in Act 3 as part of your business, like a next. But in terms of as an upside case, but in terms of underwriting a base case, we like to look at what are you doing today? Product, service, you know, how are you acquiring customers? These are all businesses that are a go. They can be pre-seed. I just led a deal in a dog food company in Mexico, $2 million deal at a $5.5 million pre-money valuation. The company has thousands of customers already, $50,000 a month of revenue, right? So there's like lots of littles there, very, very different than someone coming to me and saying, you know, Farmer's Dog's doing so great here, I have an opportunity to build that company in Mexico, right? Like, these guys are doing it on their way. And so we look for just the initial semblances of product market fit, founders that are just out there doing it. And then we look for an engine, or an economic engine that can be profitable. It doesn't have to be finely tuned at that point, but if you're coming in and telling us, like, I built this thing that's really, really needed, figure out how people will pay for it. No way, Jose. It's just that's not how we do things. That's a West Coast style of investing, and you can get money that way, certainly.
You guys are more metrics focused.
Yeah,
KPIs are trying to.
Yeah, we call it East Coast style, like, we'll miss the Snapchats, we'll miss them. That's totally fine. But we will, unless from the gate they're monetizing and they have clear kind of, you know, proven growth ability to spend. We constantly are looking at the amount it takes to acquire a customer compared to the gross profit that you can get from that customer over a lifetime. We typically look for that to be about 3 times. You know, that's kind of that basic equation of the health of that engine. So if you can check all of those boxes, there's something interesting, right? There's competence and relevance as a founder. If the market opportunity is sizable and there's precedence for big companies being built, and then if you've established the semblance of a strong early economic engine, then there's something for us to talk about leading.
I think it's interesting because I think the pendulum is swinging more towards that East Coast style of investing during an economic downturn. It's like you guys have always been investing in the fundamentalist type of style. So now
It's really the
for you guys.
It's really the difference between venture and growth.
Yeah.
You know, venture is true venture investing, I think is kind of not needing the spreadsheets. And I think what we do at Left Lane is we kind of marry the two. I think those are the best businesses where, from a venture standpoint, you see the huge upside and disruptability. Our best performing company to date was a seed stage investment in an online tutoring company called Go Student in Vienna, Austria. I mean, from a data standpoint, they were really good, but also from just this is right at the beginning of COVID, online learning alternative to schooling, or supporting schooling at $25 an hour. Sounds like a pretty good growth opportunity, disruptive opportunity. So I think, forget where I was going with that one, but.
Just like how that was like a non-obvious one. It you know, like came to you guys at the right time in the market.
Yeah, you just need to be like super mindful. Sorry, I lost my train of thought. Where were we going again?
I think it's about vision and fundamentals of striking the right balance.
The intersection.
Yeah, sorry, yeah. So I think we do a good job of doing both at Left Lane.
Yeah.
I think that right now, people are definitely giving way more, you know, to the East Coast style of growth investing. I mean, you have to, and by the way, like, for your own sanity, you should be building businesses that don't need venture dollars to exist. It's just a better way to live. If you're constantly optimizing for venture dollars while you're trying to optimize for a good business that is needed in the world, it's just tough. And that's why it's said some of the best companies get built during this generation, because entrepreneurs aren't on the juice. Like they are learning how to build. Yeah, they're learning how to build successful businesses from the onset. So, like a lot of people are afraid to charge a little bit more in price. 10% increase in price can make a huge difference, and a lot of times it doesn't have any effect given elasticity on the customer. So I just think you have to be really scrappy. And entrepreneurs, I can't speak as much to the early stage, but at least for us, when we're leaning early, are much more looking for the underlying performance.
Yeah. Awesome. Great. So we still have some more slides to cover here. Next slide. One of my favorite strategies of really kind of building up that momentum for a lead is really thinking about how you can find strategic angels. So I kind of started my career in venture as an angel investor, and there are cohorts of angels that can really add a lot of expertise in human capital. It's kind of like the size of checks that they write is not actually the ROI you get out of that is like far greater. So certain groups of angels that I'm a huge fan of is Backbone Angels. That's a group of women, angel investors that came out of Shopify. Hashtag Angels is a group of women who came out of Twitter. So a lot of these angels start to kind of form out of liquidation events of large companies. And they're also a great way for you to diversify your cap table. Okay, next. Thinking of intros, I think this is like the art of fundraising that a lot of founders learn through trial and error. Not all intros are equal here. Thinking about like how the venture relationship neural network is mapped out is oftentimes the warmest intros are the best ones. These are the ones, founders who already have been invested in by that firm, putting in a good word for you, that is really going to be the strongest strength of signal. Having other trusted advisors to that firm, reach out to them. We obviously work with a lot of firms, so we like to be facilitating intros as well. And then, cold outreach is one of those. It really depends on the craftsmanship of the introduction that you're reaching out to VCs, like making sure if you don't have a direct into a firm that you've done the due diligence, you have personalized the intro email, you're reaching out, you're referencing bodies of work, other investments, blog posts that VC has written to really show, that you've done the kind of like personalization and kind of bespoke craftsmanship of that introduction. And then having other VCs who pass on you introduce, that's usually not a great signal. VCs are constantly sharing deal flow with each other, and there's really, strong deal flow and there's weak deal flow. So we don't recommend having a VC who says no, make intros to other folks, because think of it in terms of like, can they vouch for you? Can they really, stake their reputation on you if they were to introduce you to someone else? Next slide. And then in terms of preparing for that first meeting, make sure you're doing the work of like having all of your collateral together. It could be a pitch deck, a one-pager, a deal memo, whichever format you really want to come prepared with. Understanding the thesis of the investor is super key, like knowing how you're aligning with either their focus area, their thesis, or their taste and preferences. Don't ask for an NDA at the very beginning. Like most of these meetings are not going to be proprietary conversations, and these are more get to know you meetings, especially for the first meeting, be quite informal. And you don't have to rush the process. This is kind of like a dating phase too. You're not going to get a check the first meeting you have. It does take time and kind of getting to know each other from both investor and the founder standpoint. All right, next slide. And in terms of like how you think about winning pitch decks, we always emphasize these kind of 6 fundamentals. Jason already touched on the market size, like having a market size slide that is not boiling the entire ocean, showing that like the total addressable market is 100 billion is not helpful. Being able to really quantify that, show how much addressable market, you know, is there, the TAM versus the SOM, and like being able to reference competition and really thoughtful kind of benchmarks for what you're building is going to be way more compelling. Next slide. And then having, you know, a series of no's is actually not always a bad thing. Like being able to kind of decouple the rejection therapy from the fundraising process and having the persistence to keep going is super important. You know, having a no, you can oftentimes push back and ask for a clear reasoning of like, is it no because the company is too early? You know, asking for actionable feedback too, like, is the VC viewing the team as not the right team or the business model? I'm curious, Jason at Left Lane, when you guys say no, like, what are the kind of common reasons that folks get passed on?
There's so many reasons. I think a lot of times it just doesn't fit. Like I was saying to you guys, we have very kind of narrow criteria.
Yeah.
It's not so narrow, but if it's we focus on certain types of consumer internet businesses. So if it's to B2B or it's to consumer, then that doesn't fit in our funnel. If it's being able to show product market fit, then it doesn't get it through our funnel. If that economic engine is not kind of set up in a way, if you're paying $100 to get a customer that gives you 50 back over time, that doesn't really help us. And we pass a lot of times for economic efficiency. I think a lot of times we're specifically looking for businesses that have retention, where you can acquire a customer and they can stay with you time and time again. So a lot of them are filtered out based on that profile. Any one-time e-commerce business gets kind of filtered out from us in that respect. Lack of growth. The businesses that we're investing in are hyper growth businesses. What else? Why are the reasons do we do this? You know, a lot of time, and you should definitely try to push for a real reason, because if you don't, VCs generally won't give it to you because they just want to pass in a really non-confrontational way that keeps the door open in case they're wrong and you absolutely crush it.
Yeah.
So you definitely want to ask. You know, if it's lack of capital to deploy those things, that's not on you. It's frustrating that they're probably taking the meeting in the first place. But I would say 90. So we take a follow-up meeting with 10% of the companies that we meet with initially. And I'd say the vast majority of those get screened out just because of fit. Just not what we look for.
Yeah. So it's just don't take it personally.
Don't take it personally, and also find the VCs that fit.
Yeah.
Look at your competitors, see or look at businesses, not necessarily competitors, because you want to be mindful of pitching people that invest in your competitors, but similar businesses, similar business models, who's invested in those, and go look at those folks. You also do want to limit your no's. You don't want everyone in the community, in the VC community, being like, yeah, I talked to that one. You want to kind of manufacture a teeny bit of exclusivity, and the way you do that is by being pretty targeted with the VCs that you talk to.
Great, next slide. And yeah, this is ways, you know, one of the ways we work with founders is through this monthly fundraising workshop. But if you guys really want to dive deeper with us, we can, you know, help connect you to other founders who are also going through the fundraising process. At the end of, you know, this event, we're going to send our event recap email. So that will have a link to Orbit, which is a peer-to-peer learning platform where you'll get matched with other like founders who are kind of going through the same process as you are. If you do choose to work with us as a banking partner, you get access to people like me. We can help you with advisory, fundraising, thinking about, talent acquisition, go-to-market strategy. You'll also get to work with, a team of ex-founders, VCs, and operators. So definitely, as you embark on this process, like think of us as a resource and a sounding board for you. And I really want to thank Jason for attending and sharing a lot of his market insights. If folks want to learn more about Left Lane, like where should we reach you?
leftlanecap.com or jason@leftlanecap.com. It's great. There should be a couple of videos and stuff online, so you should be able to. And then I think either my partner or I have a podcast or two that you can listen to and get.
What's the name of the podcast?
Sense. And so my Harley did one with Harry Stebbings that I think was pretty telling.
20-minute VC.
20-minute VC.
Nice.
I did one with RJ Lumba from Growth Cap. Either one of those will give you a good flavor for kind of who we are, what we look for. And I don't know what else is out there. Just Google Left Lane, see what comes up.
Yeah. And can you guys share how much you've raised and what the deployment looks like?
Yeah, so we've a bit about the firm. Yeah, we have now raised about $2 billion in just under 3 years. This has been an incredible ride. My partner Harley and I went to college together, and we started our careers sharing an office at Insight Partners, which is one of the incumbent later stage, more enterprise software investing firms. But they taught us how to go out and hunt for deals proactively versus kind of sitting back in your room and waiting for them to come to you. And I went to Uber, and then I did angel investing and came back. But we started investing in more of these consumer internet businesses, like I defined, digital first, high repeat, and had a lot of early success. We're the first investors in Udemy and HelloFresh, and Freshly, and Farmer's Dog, and Trivago. About 3 years ago, Harley, Vinny, Dan, my two other partners with Harley, we decided to kind of go out on our own. Insight backed us, and we hit the fundraising trail. It was a pretty crazy fundraise at the beginning of COVID. We did our first close right like the day COVID quarantines went into place. So our first fund, that was a close on 100 million. We did that Go Student company in April of 2020. We did another company called M1 Finance, which is a wealth management business in May. And things were kind of off to the races from there. We were 4 people, now we're 31. We got 2 floors in Brooklyn, and we love what we do.
I'm curious, what percent of companies that you evaluate do you get from hunting versus like inbound?
So 70% of the companies that we invest in are we hunt.
Okay.
And it's not even we, like the partners, these are analyst associates. So don't necessarily discredit if you're first talking to an entry-level person. That's how I started. But make sure you're being efficient with your time and not giving them too much information. But yeah, we hunt the vast majority of our deals, and it was 70% in fund 1, it was 70% in fund 2. I imagine it will continue to be the same.
Yeah, very cool. Yeah, it's very true to the Insight DNA.
I mean, you're doing something good when you start getting those emails, right? Like there's a lot of firms now that do this outbound sourcing that we were trained on. And so probably hitting on some sort of interesting trend or getting some traction if we're getting those. If not, you just got to reach out to folks and create the relationships. But yeah, most of our deal flow is outbound, started by we got now 18 folks on the investment team that are kind of pinging away.
Well, congrats on the success of growing the firm so quickly. It's
Thank
an
you.
Impressive ride. So,
Thank you, and thank you. SVB has been an awesome partner for us, helping our companies grow even faster. On the venture debt side. Oh, Mickey's gone. He's gonna give me.
Mickey from our venture relationship management side too.
I was gonna give him some.
I'll let him know.
Some love, but no, thank you. Happy to answer any specific questions or whatever we can do to be helpful.
Awesome. Thank you. All right, thank you all, folks online for joining as well. We'll definitely send out a recap with all the relevant links that Liz referenced for you guys to kind of do more research on your fundraising process. All right, take care. Have a great rest of your week.